Hi everyone, Piers Bolger here, just to provide an update on the performance of our multi-asset portfolios and our current asset allocation positioning. If we look at the performance of the portfolios through the back end of 2020, we were really pleased with the outcomes of the portfolios. All the investment portfolios were able to achieve their CPI plus objectives through the back end of last year. And this is despite the fact that obviously 2020 was one of the most challenging investment periods that we saw over the last decade. Our ability to be able to make security, manager and asset allocation changes in a timely manner certainly benefited the ability for us to both mitigate the downside risk to the portfolios, but also take advantage of the opportunities that presented through the second half of last year. In terms of our asset allocation positioning heading into 2021, we continue to have a growth bias across our portfolios. If we just think about our balance strategy as an example, we're roughly 10% overweight to our neutral position in growth assets. Now this isn't all in the equity sphere. We've got some increased exposure both in terms of our growth assets in alternatives through direct infrastructure and private equity, as well as obviously increasing our overall positions in equities, both domestic and global equities. Within the equity sphere, we've increased our positioning in small caps, both domestic and global, as well as emerging markets, which we continue to see play a recovery theme in a post-COVID new normal environment. As it relates to cash and fixed income, we remain at our maximum underweight in our cash positioning within our portfolios. With cash rates virtually zero all around the world, we see little value in holding an excessive amount of cash in portfolios at this present point in time. In terms of the fixed income exposure, it's really quite interesting. Bond yields have moved higher over the last 3-month period, and we expect bond yields to continue to move higher as the economic recovery picks up through the second half of this year. This will put pressure on the performance of fixed income investments, particularly duration-based investments. Accordingly, we've been reducing our exposure to both domestic and global fixed income within our portfolios. We've continued to maintain our credit positioning, albeit noting that credit spreads have moved narrower. But we think as the global economy starts to reopen, the ability for corporate credit to again deliver solid investment returns we still see is there. So we're quite happy to maintain that exposure within our portfolios at this point in time. As it relates to property and infrastructure, on the listed property side of things, both domestically and globally, at this stage we remain underweight. Property assets have clearly been impacted on the back of COVID, and we do think that there are some medium-term opportunities, but we would expect to see and would like to see sort of the opening up of the global economy before we start to repositioning our portfolios within this part of the market. Where we have liked to increase our allocations has been in the infrastructure space, both on the listed as well as on the real asset side particularly. We see longer duration assets in property and infrastructure is offering some downside protection to our equity exposures, whilst also providing the ability for longer term capital gains coming through. We see this as a great way to balance out our overall portfolio configurations. As it relates to our equity exposures, this continues to represent the most significant part of our portfolios. And as I said, we remain overweight equities, both domestic and global. We've been increasing our overweight exposure to domestic equities over the last little while. We see Australia better placed than many of its peers around the world in terms of dealing with COVID, and we think this will be advantageous to the growth outlook within the domestic economy throughout 2021, certainly at this stage. And within that, as I said, we've been adding to our small cap exposure that we feel can be leveraged to a pickup in the economy throughout certainly the first half of this year. In a global sense, we've been really balancing out our exposures, but have been adding to our emerging markets and small cap exposure. Again, very similar themes on the domestic front, just leveraged to a pickup in the growth environment that we expect to see throughout the course of 2021. And within our alternatives exposure, we've been adding to growth assets as opposed to defensive alternatives, predominantly both in regards to private equity, but equally in terms of some of our direct infrastructure and other total return growth strategies. We see this as a way not only to manage the overall risk of the portfolios, but it also provides an offset to having our exposure just solely focused on growth within our equity part of our portfolios. Overall, we continue to believe that equities are going to deliver some reasonable returns for investors, and certainly on a relative basis, better than what we're seeing in the fixed income, cash and other defensive parts of the market at this stage. Doesn't mean we don't maintain exposure to those parts of the market, but as I said, we continue to look for opportunities, and where we see it at the present point in time, we think the best opportunities are in the growth sphere. Doesn't mean that we won't see ongoing market volatility. In fact, I think it'll be probably just as high this year as what we saw through the course of 2020. But the ability for us to be able to manage that, as I said, through security manager and through our asset allocation framework, we believe will result in positive performance across our portfolios, and the portfolios continuing to achieve their longer term objectives.